You think your bank is your friend. That's the way they market to you. Their whole pitch is they spend thousands and tens of thousands and hundreds of thousands and millions at a national scale of dollars advertising the point that they are your friend and they're there to serve small business. Well, let me tell you what, they're there when you don't need them. My friend Nathan found that out. Nathan owned a small trucking company and he was successful, was thriving. He would take, it was a short haul business. He picks up cargo that comes in overseas at the local port, and then he takes it to a temporary holding warehouse, and then it's transferred from there to long haul truckers that go nationally. Nathan had been banking at the local bank for, I don't know, 10 years for his business, kept all of his deposits there, had a great relationship with his banker. They're all about relationships. And he had this opportunity to buy a warehouse. He saw all this profit flip opportunity just flowing right through him. His customers were paying these warehousing companies just egregious amounts of money to store their goods for 24 hours, sometimes 48, and then turn around and ship them out. And Nathan's like, hey, I'm already transporting their goods. I'm basically the conduit from the ship to the long-term trucking or the rail line. And if I could grab a warehouse myself, I could just pick up all that profit. And he identified a warehouse, found one. It was the natural next progression in his business, goes to his local bank with his relationship. And he found out that the lesson that most business owners and entrepreneurs ultimately find out at some point in their career when they deal with their bank is the bank isn't your friend. The bank is in business for themselves. You're really not their customer. You're a necessary evil. Their customers are the bank regulators, their board of directors, their shareholders, and you fall somewhere down there on the pecking order. So they'll loan you the money if it makes sense for their portfolio, if it's what they're trying to do, but their appetites change all the time. I remember in 2008 when we went through the great financial recession, sitting around a table with a bunch of CEO friends of mine, and there were 12, 13 of us around the table, and I would say a good 50 to 60% of them were complaining and lamenting the fact that their bank called their lines of credit, shut them down, and in some cases called the notes that they had, even though they were making payments on time. And the reason was the banks had a liquidity crisis and they were concerned about extending any more credit, and they had a change in portfolio decision overnight. And a lot of banks have in their notes, they have call features, things that they can do. And in some cases, if you're underperforming in one area, your business takes a hit, that's considered a default, even though you are making timely payments with whatever loan you have. His bank offered him one option only for the warehouse with a massive down payment. And fortunately, Nathan came to us. We were able to work with him and we were able to help him secure the warehouse on amazing terms, 25-year fixed rate terms with a very low down payment on the building. And now his business is thriving, has gone to the next level. The other thing is that these banks, one is they want your deposits. And that's really what they're after is they want your operating account, they want your cash, because they can take the cash that you have and they can lend it out and multiply it using the fractional banking system over and over again. And they lend it out to higher interest rate products like credit cards and boat loans and car loans. And on shorter terms that typically turn over and over again. That's what they're really after. And think about it. If you have a $2 million business, you're running somewhere in the neighborhood of $150,000 to $200,000 every single month through your operating account. Now, of course, it's in and out. You've got payroll, you've got different expenses that you have to pay. But at the end of the day, your average daily balance is very healthy and they use that money and that they're not paying you interest on that, but they are using it. And many of the local banks will demand that if you go get a loan with them for a building or any kind of real estate, that you move your deposits to them. And sometimes they'll demand it. Sometimes they'll sweeten it a little bit and say, we'll give you a 0.10% discount on your interest rate. But the reality of the matter is the opportunity cost for that is very high. And not to mention that from a defensive standpoint, if the economy does turn or you hit a rough patch in your business and you need access to that cash, do you really want to keep your cash in the same bank that has your loan? Particularly when things maybe, again, you hit a rough patch and potentially you're in default just due to the fact that your financials that they a lot of times require you to submit every single year when you get a commercial loan with them aren't performing the way that they would like them to perform. So you got to be really careful with working with the local bank and the relationship that they pitch as the solution. Again, when the grass is green and the sun is shining, it's a great place to be. But if there's ever a sea change, it's not a good place to be in most cases. So remember, back of your mind, tread with caution, deal with them if you must. And we do in many cases. And there are a lot of really good banks out there. I'm not castigating banks per se. We work with a lot of banks. But I'm just saying, be wary of the bank as your friend and the banking relationship, because more than once we've been caught off guard as entrepreneurs by the banks who really aren't there to serve us. They're there to serve other masters, regulators, shareholders, stockholders, board of directors. You get it.